Tēnā koutou katoa, nau mai, haere mai. Welcome to this Legislation Design and Advisory Committee webinar about the fees and levies outlined in Chapter 17 of the Legislation Guidelines. In a moment, I'm going to ask our panel members, Carl and Jean-Pierre, to introduce themselves. Before doing that, I'd like to do a couple of things. Firstly, let me introduce myself. I'm Guy Beatson, and I'm one of the Deputy Chairs of the Legislation Design and Advisory Committee, otherwise known as LDAC. I'm also a non-public service member of the committee. My day job is General Manager, Governance Leadership Centre at the New Zealand Institute of Directors, where I lead thought leadership, policy and advocacy, and as IOD's Registrar, I have responsibility for Director Professional Standards. My background is in economics rather than law, quite useful for today's topic. Secondly, I'd like to introduce you to LDAC and give a bit more detail about today's deep dive webinar. The Legislation Design and Advisory Committee is made up of members appointed by the Attorney General to support good legislative design. It's a mixture of public service and non-public sector service members. All members are voluntary or unpaid for their LDAC work, and in the case of the public sector employees, their time is loaned by their employer. PCO provides secretariat support, including advisors, to support the committee. And members have a wide range of backgrounds given the combination of the different sorts of members we have. We draw members from the legal and policy teams within departments, Crown entities, as well as academics, lawyers, barristers, and consultants. And a broad range of skills and experience is important because good legislative design is multidisciplinary. It's not just about the law. We have three functions. We publish and maintain the legislation guidelines and supplementary material. That's Government's Handbook for Good Legislation Design. The most recent edition was updated in 2021, but the guidelines have a decades-long history and are direct successors of the LAC guidelines. We carry out education and engagement activities like the session today, but also with departments and a range of issues. Both these activities extend our reach beyond our advice functions. It's common to see submissions to select committees that refer to the guidelines, and ministers are required to address consistency with the guidelines in cabinet papers for bills. Our advice functions apply at two different stages. The bulk of our advice work is prior to introduction, when we advise departments that come to us. We also make submissions to select committees. We aim to support good lawmaking. We are guided by the guidelines and supplementary material. The guidelines are not about policy. They're about expression of policy in law. This means you'll not find us giving an opinion on policy. It's important to remember that the guidelines are just that, guidelines. These are not rules that must be followed. Our goal is to ensure that conscious design choices are being made about legislation. In today's webinar, we're going to do three things. We're going to provide you with some key things to pay attention to when designing fees and levies to be included in legislation and some practical tips and tricks for doing that. We're going to talk about the specific issue of cost allocation to achieve effective outcomes and some of the stuff that's in the guidelines as well as some of the material from the Treasury. We're going to finish with a discussion about empowering provisions and cross subsidies. So let's now introduce our panel members. Before we get underway, let's turn to Carl first. Do you want to introduce yourself, Carl?
Kia ora tātou, Carl Simpson aho. I'm a member of the Legislation Design Committee, also work for the Parliamentary Council Office. My job is to head the System Stewardship Group within the department.
And turning to Jean-Pierre.
Hi, it's Jean-Pierre Andre here. I work in the Public Finance Policy team within the Treasury. My main area of work is policy issues, especially around the financial aspects, as the team name would suggest. If they're complicated legal questions, I think Carl would be the right person to discuss those. If they're more appropriation accounting issues that Treasury deal in, then I'm the right person. Thank you.
I think we've got a really good combination of law and economics and finance between the three of us, so that's great. And as you say, JP, before we get into the discussion, I'm sure you're going to have questions. So please don't wait until the end of the discussion that I have with the panel today. You can ask those questions at any time using the Q&A button at the bottom of your screen. So now let's get going. If I can turn first to Carl, what are the key messages that you think we need to get across to our participants today in terms of designing a fee and levy regime to be included in the legislation?
Thanks, Guy. So I'm going to focus here on policy and legislative design. Firstly, I want to highlight the importance of considering funding when you're designing a new system or altering regulatory functions. It's not just about what those functions are. It's critically important to think about how those things are going to be funded. So in other words, if you're creating or changing functions in primary legislation, you need to address how that function is going to be funded. And if you don't provide for how they're going to be funded, or if you haven't thought about how they're funded, then there's a significant risk in the system to provide for those functions to exist. The second point is that there's really only three sources of funding. So the first source of funding is charges for goods and services, which are generally called fees in the guidance, and these are associated with the provision of private goods. The second source of funding is charges that are imposed on system participants to fund activities. These are often called levies, and they're associated with club goods, often on the basis of people who add risk to the system or benefit from a well-regulated system. And the third and final source of funding is Crown or taxpayer funding. So the general taxpayer pays rather than people who participate in the regime. And those are through an appropriation and are associated with what we call public goods. So in most systems, there's a policy rationale for all three sources of funding. There's usually applications or a process or registers are run. There's usually people who can be allocated different classes who benefit from the system or add risk to the system. And there's usually some element of public good. I mean, that's usually why we're regulating in the first place. So when designing a system or substantially reviewing it, you should consider the role of all three sources of funding when you're designing that, and consider how that might change over time. So the best systems, in my view, are those that have well-settled policy frameworks for how they do funding, and some of the most advanced are to be found in MPI, which is quite a well-structured system for how it thinks about cost recovery, and also the transport sector has, based because of all the different funding opportunities in there, has to think quite sophisticated ways about funding. The third key message is that if your existing regime has an older fee or charge power that is being used to fund things that look a bit more like a levy, our advice is to take the opportunity to provide explicitly for a levy using one of the more recent models for that. So it's important not to simply carry over old provisions. And then I'll wrap up with a practical point. We don't live in a perfect world. Sometimes we have to make do with what we have. Sometimes there are limits of what we can achieve in that particular moment. So we always have to be realistic.
Well, and pity we don't live in a perfect world, hey, Carl. But and talking about perfection, let's turn to the Treasury perspective on this, JP. What are the kind of core messages from the Treasury's perspective in this kind of legal frame of fees and levies you'd want to convey to our participants today?
Well, first, starting with a bit of context, Guy. During a period of fiscal constraint, fees and levies could gain prominence as a funding option. Agencies may examine new ways to fund new and existing activities to avoid extra fiscal burdens. I think it's important to take an intuitive approach to what is often considered a mainly technical issue. I hope this take on how to think through a range of fee and levy issues can help you engage with the existing fee and levy guidelines, plus to distinguish when fees and levies, as opposed to other funding arrangements, for example, whether it be commercial, contractual taxes, it is unhelpful that at times existing names can be misleading. What are substantively taxes can be called fees and levies, for example, road user charges and ACC levies. So how to objectively characterise a funding arrangement can require some judgment. This is a common issue with this topic. Many times judgment is needed around a set of principles when what we all want is simplicity. The key message for me are that agencies should be striving towards developing efficient and effective services. That is, do the right things and do them right. Accurate costing methodologies guided by transparent judgments is also needed, and demonstrating fairness and compliance with the rules, plus regularly reviewing arrangements as circumstances change, especially if memorandum accounts are showing possible mispricing. So just touching on the role of the Treasury as opposed to other people in the space, both the Treasury and the Office of the Auditor General have guidance on how agencies should approach fee and levy regimes. Treasury's focus is more about the policy issues and associated accounting and appropriation consequences. Formerly, the regulatory aspects of this topic were also a Treasury responsibility, but now it is a matter for the Ministry for Regulation. The Treasury is here to help, mainly through your designated vote analyst. Your agency finance team should know who that is and should be generally engaged early in helping with the design aspects of fee and levy regimes. This is to ensure the finance aspects of the regime are well integrated with the policy objectives at the outset. For example, to ensure how charging is done does not inadvertently impact poorly on incentives in the system. But before inquiring the Treasury, it would be helpful if you read the guidance and associated information to enable more targeted discussions about the outstanding issues. Generally, the Treasury will want to understand the rationale for your proposal and its associated details and how you've exercised judgments to meet the various requirements of such regimes. This will help us form our own assessments and to advise you and ministers about options. Back to you, Guy.
That's fine. Hey, thanks, JP. And I do think there's a really important message in what you've said before I kind of summarize what you and Carl have pulled together. And that is, in order, the Legislation Design Advisory Committee is not going to ask you about your policy in terms of how you got it, but actually expressing that clearly, which is kind of going to come through some of those conversations with the Treasury and others, is pretty important. So let's just summarize the core points from both yourself, JP, and Carl. In your design process, ensure you treat both the funding for regulatory other government functions and what those functions are as equally important. The two things go together. The best systems have funding principles, and that's really important if you're going to translate that into sensible legislation, because you can then follow through the theory of that in an appropriate way. Picking up Carl's point, beware of older legislation that refers to a fee. It may not be, but it's actually providing a funding system more akin to a levy, for example. It might even be a tax. And avoid carrying that type of misleading wording over into the newer amended regime. That's one of the reasons why you have some level of regulatory stewardship and law reform. We may see an increase in the authorisation of charging fees and levies to avoid additional fiscal burden. That's a way of almost saying, look, be really careful about how you frame this stuff. It's not just about raising the revenue. It's kind of what the revenue's for and how that works and how do you translate that into legislation. And while this can be technical and complex area of law, it's helpful to remember that a lot of the answers can be found using intuition and applying relevant principles. And you can use the resources available, as this JP's pointed to, including other well-designed regimes and your designated vote analyst at the Treasury. But also, as JP's pointed out, there's quite a lot of helpful material in the Office of Auditor General's website as well. I'm sure this discussion has raised some questions for you in the audience. If you have those questions, just a reminder, don't wait until the end. Please ask your questions using the Q&A button at the bottom of your screen. So that's kind of almost the theoretical view of what we're trying to do, the key message in terms of designing these fee and levy regimes as they apply in legislation. We're going to now turn to some more practical advice, almost some tips and tricks from both Carl and JP. So let me turn first to Carl. What do the legislation guidelines cover in relation to authorising the charging of fees and levies?
Yeah, so the guidelines have a lot of information about and practical advice about fees, particularly in the context of secondary legislation and also levies as well. So I'll just dive into that quickly here. So firstly, legislative authority for fees and levies is usually granted by empowering provisions that authorise secondary legislation. It's also worth noting that there are some exceptions there you have to be aware of, such as where the Crown's effectively in trade and is charging commercial rates for goods and services. I think about that as being like the king getting rents from their lands. But those are relatively rare, but they do arise and you need to be aware of them. Secondly, there's an important distinction, fundamental distinction about whether or not a charge is a tax. I often remind myself that Parliament's control over taxation and spending goes back to the medieval origins of Parliament itself as an institution. So when you're looking at a charge, think, if this is a tax and a tax where there's a lot of discretion over what that money can be used for, this is something that Parliament has traditionally been has jealously guarded its power to do that. And that's why it's reflected in the Constitution Act. Whereas if you're talking about fees for services, those are things that are easily able to be put in delegated legislation. And if you're thinking about levies to fund a function that Parliament has set for someone to do, then that's a thing that's appropriate for a levy also in secondary legislation. So the guidelines cover when to charge fees. So the guideline says a fee should be charged only if the nature of the service or function is appropriate, and the fee can be quantified and efficiently recovered. Then it talks about when it might be appropriate and when it might be inappropriate. So it says that the service or function is rendered to an individual or confers a benefit. That might be where a fee is appropriate. Conversely, a fee may be inappropriate where the service or function is provided to the community as a whole. So that goes back to those basic ideas of what a fee or a levy is compared to a tax. Other considerations included in the guidelines and also appear in the Treasury guidelines and the OAG guidelines are about quantification and ease of recovery. But the crucial legal rule reflected in the guidelines is that a fee should bear a proper relation to the cost of providing the function or service to which it relates. That's a flexible test, but with limits. And the key to meeting that test is a good cost allocation model that you've worked through. Guidelines then discuss whether the objective or function should be subject to a levy. The guideline around levies is that levies should be imposed only whether it is appropriate for a certain group to contribute money for a particular purpose. So the guidelines state that levies are charged to a particular group, often referred to as a club, to help fund a particular government objective or function. In some cases, it will be appropriate to use a levy to pay for those costs. In other cases, it will be appropriate to use a tax-funded appropriation. So the guidelines are taking you back to first principles there. So helpfully, the guidelines do then go on and talk about more machinery requirements, about what should be in empowering provisions, including things about waivers and process requirements. I also note that PCO is working on developing model provisions for basic fee powers to be used in new provisions, and has started consulting some key agencies there. The objective of that work is to provide a more uniform starting point for new powers, but we always recognise that every context is a little bit different, and so those will need to be adjusted and as they get implemented in the future. In summary, the guidelines are really intended to help you navigate the process of designing fee and levy regimes. I've kind of touched on the surface of the guidance, so it's worth familiarising yourself with the whole chapter. The guidelines also have recommendations to refer to those other useful resources, including the Treasury and OAG guidelines.
Yeah, that's really great, Carl. And I guess the thing I think our audience and others will applaud is the work that PCO is doing on those model provisions as well. That's a really useful step forward in the sense that you're not having to reinvent the wheel, but also gets consistency. Now, you referred to cost allocation, which is buried a little bit in Chapter 17 of the guidelines. I want to turn now to JP to talk a bit more about cost allocation, how officials should approach that to achieve the most effective outcome, and what the key considerations around that cost allocation are. Do you want to give us a bit of a flavour of that, JP?
Sure. So first of all, agencies should always be striving to produce the right goods and services at the least cost for the level of quality and quantity desired by Parliament and ministers. Irrespective of who pays for the goods and services, they need to be justifiable in scale, scope, and quality. This is required for accountability reporting to the Executive and Parliament, that is, in the estimates and annual reports, and applies the same whether there is government or third-party funding. But ongoing improvement is not easy when goods and services provided are highly specialised, and so there are few comparators for benchmarking. However, it can be appropriate to benchmark elements of delivery, for example, administration costs, and as discussed more later, use stakeholder consultation to help with design parameters, as well as utilising ongoing feedback about the quality of regime execution. Nonetheless, to achieve a successful charging system, you need to ensure that you're using a robust and comprehensive method for recovering costs, and ideally no more. Otherwise, we're not talking fees and levies, but taxes or for-profit commerce. A good accounting methodology should take into account the operational context of your public organisation. That is, Accounting systems should not be gold-plated, but be sufficient to be able to justify the charges. At a minimum, for goods and services to be funded by fees and levies, you should be able to identify the total costs of producing them by assessing variable costs, fixed costs, and overheads. If you have different customers, including the Crown, before charging can be considered, cost allocation methods are needed. This may include activity-based costings that are cognizant of the cost drivers for delivery, so the links between output volumes and corresponding costs are known. Assigns marginal costs to associated activities. Note that these can be small relative to fixed costs and is generally easier to do. Also, apportions an allocation of overheads to associated activities using a methodology that can be justified. A classic case would be how to provide for the allocation of depreciation on fixed asset. You need to recognise that salary and wages are often the single largest expense and are typically fixed short term, irrespective of the volume of business. Now, COVID-19 has shown this. Unless an agency can outsource its labour input via a contracting model, its wages are fixed short term. So apportionment of labour costs is very important and may require timesheets or proxies, at least for short periods, to know how time is being spent on various activities. Now, transparency is needed when there is judgment involved, such as an overhead allocation. But no allocation is perfect, and so inevitably there will be some rough justice, which could lead to undesirable cross-subsidies in any fees and levy regime. It's just a matter of degree. The acceptability of this is a judgment about how close the costs charged for match the benefits of delivery. Too much difference and it starts to look like a tax, which must be explicitly authorised by Parliament to be legal. Remember, long-term, all costs are variable as substitutes become feasible with technological and commercial change. Plus, demand can vary too with societal change. So agencies have to be flexible to respond to changing circumstances and regularly review what is appropriate. At times, you may need to use a combination of fees and levies to achieve a successful regime for the delivery for a range of functions. An example of where we can see this is within certain industries that have registration. In this case, the industry participant may need to pay a registration levy that supports a host of functions, including administration. Then, additional optional services like further education may be available through an additional charge. Many professional bodies have such structured charging regimes within which they operate, for example, in the building industry and the associated trades. So now I want to touch on who pays. Again, this is an issue of judgment. Once you're confident about the efficiency of services and the ability to apportion costs, the question becomes who should pay what and how. The answers to these questions may depend on policy objectives. For example, some services may need to be encouraged through part charges, such as vaccines. And also the range of delivery options matter. For example, joined up agency solutions may be possible. But there are some general rules of thumb. If it is a public service or good that is non-rival and non-excludable, then funding from the Crown is appropriate. For example, policy advice. If it is a private service or good that is rival and excludable, then funding from fees can apply, such as there is individual benefit, for example, a passport. If it is a club service or good that is non-rival but excludable, then funding from levies can apply as specific groups identified as the beneficiary, for example, an industry regulatory body. Depending on the circumstances, it's feasible to use a mix of all three types of funding mechanisms. In this situation, funding streams should be carefully separated, so cross-subsidies across customers' groupings can be avoided. We'll talk a bit more about cross-subsidies in a moment. Once a possible funding solution has been found, consultation is needed. Effective consultation is to identify likely impacted stakeholders and the likely issues of concern to them and give them a good chance to comment. That is, you need enough time and information in a form that is helpful to engage with stakeholders. This is also an opportunity to better understand the ramifications of a proposal, whether it be a change to an existing regime or a new one. and so to find any unintended fishhooks or areas for possible improvements. For example, to reduce significant compliance costs, mitigate concerns about the fairness of the distributional impacts of possible cost allocation options, and address possible undesired impacts on the demand for services. Remember, consultation is not a negotiation, but it requires an open mind on how to respond to feedback. It can be appropriate not to consult if the repercussions would be to the public detriment, but this would need to be justified and highlighted clearly. In the development of a good quality regulatory impact statement or cost recovery impact statement, these are requirements for regulatory approval you might be aware of, showing how stakeholder feedback has been taken on board, and if not, why is necessary. Lack of effective consultation is a common reason for one of these regulatory documents to partially meet the quality assurance criteria. Now, I understand that these regulatory requirements have not changed with the establishment of the new Ministry for Regulation. So I'll pass back to you, Guy, at this point.
Yeah.
Thank you.
And that last point's a really good one. And just to reinforce the consultation point of view, I mean, if you go and look at the guidelines are very clear about the need for consultation. And if it just add to JP's observation, and the other benefit of having consultations is you can explain some of these cost allocation questions, or at least the options for them, to make sure that those people who might be subject to these fees and levies can understand what's going on. I'm also mindful, JP, of your observations about membership organisations. I had a flash in terms of the Institute of Directors, because we face exactly the issues you talked about as you were talking. So let's capture what we've heard in terms of practical advice from Carl and JP. The legislation guidelines provide helpful insights to support you through your design process. This includes guidance about when to use fees, when to use levies, and how to approach empowering provisions and confirmation. And just to reinforce Carl's point about model provisions being developed by PCO, which will help that as well. It's worth keeping an eye out for updates from the PCO regarding their work on those model provisions and basic fee powers. And irrespective of who pays for the goods and services, they need to be justifiable in scale, scope, and quality. In that sense, a successful charging system requires effective and comprehensive cost accounting methodologies. And much as that might seem arcane in terms of some of the stuff that JP's talked about, it's absolutely vital. It's important that you're able to identify, as far as practicable, the total cost of providing the good or the service. And Jean-Pierre's provided some great guidance on how to make the judgment of who should pay. And if you want to delve more into that matter further, look at the Treasury resources or get in touch with the vote analyst at the Treasury. Now, just one final little reminder before we go on. If you have questions, please ask them using the Q&A button at the bottom of your screen. We've got one or two. I'm sure there are many more from our audience of more than 100 people today. In our third part of our webinar today, I want to turn to empowering provisions and cross-subsidies. So I want to go first to Carl. What kinds of questions does LDAC see in its work relating to fees and levies?
So because we focus on primary legislation, some of the key things we see are about that primary legislation. So we see new legislation that doesn't provide for how it's funded, or only provides for that as an afterthought. And so to reiterate my earlier points, you need to think about fees, levies, and Crown funding early, and don't just assume that the old provisions are appropriate. Some of the trickiest problems that arise, and Jean-Pierre mentioned this earlier, is that the guidelines, both from the OAG guidelines, the Treasury guidelines, and the LDAC guidelines themselves, use terms like fees, levies, and taxes as if they have clear, relatively distinct meanings. However, whilst they do have distinct meanings in a policy sense, that conceptual clarity is not reflected in legislation, and the design of provisions has changed quite markedly over time, and accepted practice and interpretations of provisions has also changed. In particular, the word fee has been used for all manner of things, from obvious straight taxes like some people will remember the broadcasting fee, and also for things that are clearly goods and services with quite conceptual clarity between those two things. So the point, again, is to avoid over-reliance on the term used in the legislation. The normal rules of interpretation apply. So you read the words in light of their purpose. And the use of a term like fee is a clue, but is not determinative. What that really means is that when you're doing fee and levy regimes, I always try to do something where I try to switch gears when I'm moving from policy design to legislative design. So use those terms when you're doing the policy design. When you're looking at the legislative design or the legislative application, you need to adjust the language that you're using to match the empowering provisions that you have. We also see proposals to amend, and sometimes agencies describe this to avoid doubt. Existing fee provisions to respond to problems or perceived problems that have arisen in their work. Now, those things are always really tricky because the agency is often moving at pace. The stakes feel or are quite high, and they already have advice and have decided the direction that they're going. They might also have a regulations review committee process on foot or a court process, or they've got legal advice that they're responding to. So in that case, we advise against using avoid doubt provisions. Just one example, we've seen proposals to clarify that fees can cover both direct and indirect costs, which is a matter that is pretty well settled practice. And the real concern here is that trying to avoid doubt in one area raises or can raise doubt everywhere else in the system. And we're concerned that those kinds of changes could result in a creeping failure as each regime comes up for renewal. So similarly, we also get worried about proposals to validate charges in the absence of a clear need as opposed to a risk. But again, we recognise that these are really are these ideal circumstances. Fees and charges are one of those things that is challenged quite frequently. I mean, obviously, because people are required to pay them. And so that means that you have a tendency towards conservatism and also a desire for certainty on behalf of both users and departments. So what we try to do here is help the agency to see the options, lift themselves up above the problem that they're facing at that particular moment, and try to work out what the legislation should be providing for. And one of those things we've touched on a few times, which is if you really do need to have a levy power, think about establishing that as a separate power rather than stretching your fee powers. And overall, we find agencies are really receptive and willing to work with us on those issues, which is great. And again, when you get the opportunity, go back to first principles, try to work out what an appropriate funding model for your regime looks like, and then give effect to that through the legislation.
Yeah, it's a really nice message, and Carl, I think beyond the fees and charges piece, I mean, a set of messages about the fact the statute book is connected. So if you're working on one piece of legislation, it could actually, and you put an avoidance of doubt provision in, it affects a whole bunch of other people and potentially has precedent impact as well. It's a really important message in addition to the other things you've talked about. So let's talk about another important issue, which is pretty vexed, and JP will attest to this, I think. So we try to avoid cross subsidies. But what practical advice can you give about the use of cross subsidies and when that might be appropriate? JP?
Right. So I agree with you. Cross subsidy should be avoided if possible. In particular, if there's an egregious disconnect between costs and benefits for the paying parties, it's questionable whether a fee or a levy has indeed become a tax. A memorandum account is one mechanism for checking for cross subsidies and are mandated by Treasury instructions for full cost recovery, departmental activities from third parties. But remember, this is not for intra-government charges. This is covered in section 6.3.7 of Treasury instructions. Now, memorandum accounts show the accumulated balance of revenues less costs over time attributable to fees and levy activities. The funds are separated from broader related agency activities to avoid possible subsidisation across activities, especially if they are Crown related. For example, surpluses should not be used to fund policy advice. But that also means that agencies with multiple fee and levy activities usually need multiple memorandum accounts. Memorandum account balances must be published in accountability documents. Over time, the expectation is that these balances should trend to zero to avoid another type of subsidy, customers from one period overpaying or underpaying for the benefit or detriment, respectively, of customers in another period. I call these so-called intertemporal cross-subsidies. Unfortunately, divergent memorandum account balances are not unusual. Pricing is based on methodologies for cost allocation underpinned by assumptions that can be imperfect. Typically, demand is difficult to forecast, and underestimates or overestimates can lead to over-recovery or under-recovery of fixed costs, respectively, over time. But also between customers in the same period, if there are common fixed costs that need to be apportioned across different types of offerings with diverging levels of delivery. The real question to consider is how much cross-subsidisation is too much and what can be done about it. This is where regular reviews of methodologies and assumptions are needed to reset prices, especially if memorandum account balances are diverging from zero over time. Another reason for review could also be where there are changes in public policy objectives. To what extent can charges be changed to compensate for what has happened in the past? There can be legal barriers, but from a policy point of view, what is reasonable in the circumstances? A helpful process to work through is to think about the nature of customers, the characteristics of their delivery and associated costs, and their allocation to those customers. This can help form a judgment about the fairness and efficiency of proposed changes to cost recovery. You can also sometimes make generalizations about the appropriateness of a cross-subsidization. For example, where there are repeat customers, intertemporal subsidies are less of a problem. As to the extent customers underpay at one point in time, they can overpay at another, meaning variations in prices average out well over time. It does get harder when transactions tend to be one-off in nature. Unfortunately, simple answers are not always possible. Because judgment is fallible, there is a regulatory oversight of fees and levy schemes. This is done by the OAG, who check that public money is spent lawfully and that cost recovery through fees and levies are justified and transparent to fee and levy payers. Plus, there is parliamentary oversight through recommendations by the Regulations Review Committee. In addition, court action can also come into play. So there are a variety of parties that can come to independent views on the process of how agency judgments were formed, but also possibly on the merits. Clearly, if there is an adverse ruling by one of these bodies, it would be appropriate to review the at-fault aspects of the regime. Thank you, Guy.
That's right. So let's just sum up this question of how we design empowering provisions and think about managing cross-subsidies. It's worthwhile to re-emphasise the importance of thinking about fees, levies and crowdfunding early in your policy process, even before you get to legislation design. Be careful that an avoidance of doubt clause does not inadvertently cast doubt within other regimes who operate in the same manner without an avoidance of doubt clause. That's really important. If there's no message you take out of this, that's one of them. Do not rely on the words used in the primary legislation or empowering provisions, given the evolution of meaning over time. You may unnecessarily limit the scope of your power by doing this, particularly in primary legislation. That's something we're going to come back to with the questions from our participants. While cross-subsidisation should be avoided, it's not always possible in the way that JP's just talked about. The real question to consider is how much cross-subsidisation is too much and what can be done about it. And consider that question from both a legal and a policy perspective. And most importantly, to pick up JP's point at the very end, regular reviews are key to ensuring the continued appropriateness of the regime. And if I turn quickly, just before we get to questions from our audience, which we've got some really good questions, I thought I would just quickly sum up this webinar. To be clear, there are no hard boundaries which can cause uncertainty about whether certain actions are breaching the law or principles of charging fees and levies. While we'd love to provide definitive answers for queries about cross-subsidies, it's not practical or help for us to attempt to do this today. And I don't think either Carl or JP have done that. The continual referral back, considering how reasonable the decision is in your specific circumstances and the implications of this is absolutely necessary. And having a robust and thorough process is also important. If you're struggling with legislative design of authorising the charges and fees and levies, please reach out to LDAC for further assistance. And if you're interested in the policy advice, reach out to the Treasury for additional support. If you have significant concerns relating to compliance, refer to OAG guidance. That's the Office of the Auditor General. And there's a lot in this topic. And while we couldn't cover everything today, do make use of the recording of this webinar, as well as the additional resources we've talked about during the webinar. Now, I want to turn now to the questions we've got from our participants, and there's some really good ones in them. So we're going to start with an easy one, Carl. The easy one is, how could one of our participants find varying approaches to the use in fees and levies within different regimes?
Sorry, say that again.
How could one of our participants find examples of some of the stuff that you and JP have talked about this morning? Where do they go? How do they find that stuff for examples?
Yeah, so one way is to read legislation, of course, but I know lots of people don't do that. Another place you can look at is Regulations Review Committee digests. So that contains quite a lot of interesting and helpful discussions on unusual and unexpected approaches to the use of fee and levy powers. It's got references and discussion of reports and findings. So that's a good source of information as well.
Yeah, it's good. And one for JP, which is finally within the boundaries of the Public Finance Act. So the question really is, how do you protect the distinction between fees and levies once they've been collected? So you can collect the money. I think the question is saying, well, because of the way the appropriation system works, once you've got the money, then you've got an appropriation to spend it. How do you avoid actually a fee or a levy being converted into a tax as a result, essentially?
Well, there's a lot in that question. Well, obviously, the appropriations set out limits to what you can spend money on. And in this fee and levy regime, we collect revenues to help fund that. Appropriations are limits. They've got to be spent within the scope of that appropriation. So that prevents you, an agency, from taking money for another purpose and spending it within appropriation, because it might lead to overspending or spending outside the scope of that appropriation. Memorandum accounts obviously are a way of acknowledging how much money's been collected and the costs associated with those revenue generating activities. I mean, money is obviously fungible to a certain extent, but if you keep the balances clean, you should know where the money comes from and what it's being used for. So it reduces the scope for mixing of monies for cross purposes. I hope that answers all the elements of the question, because there are a few in there.
I think that's right. And the use of memorandum accounts is pretty important. It goes back a little bit to your point about cost allocation as well, because there's going to be overheads and other things that are common in much of the provision of those services. So cost allocation matters. Slightly interesting question, Carl. So the fee and levy model lacks the distinction between subsidies within a group receiving the same service and subsidies between groups receiving different services. And that's apparently caused some issues in various sectors. Do you have an answer to that? In terms of, because I get the point. It's one of those things where buried in all of this, you can end up with subsidies or cross-subsidization, and that might be deliberate. But it's not inherent in any of our guidance, I don't think.
Yeah, my best advice is that you need to go back to your model, so your cost allocation model. That's the best way of understanding what you're allocating to particular fee payers, or when you're talking about levies, also what's associated with the club good that your club, that your people are participant of. So yeah, so at the very start of your process, you need to be using a cost allocation model that has really clear association between the costs and the performance of the functions and the various classes of users that you're allocating those costs to.
Yeah, and what you're basically pointing to is a high level of transparency in this, right?
And then to follow it as well, and then to continue to follow it and review that that mechanism.
Which in some senses is consistent with the advice that we've talked about today, in terms of having decent principles that sit behind the fee and levy determination, what that level is, and so on and so forth, and then feeds into some of the stuff that JP's talked about as well. I guess I'm going to turn back to JP. Would it ever be appropriate to set a fee or levy for purposes other than cost recovery? And the example used is to drive or deter certain kinds of behavior. Is that always more appropriate for a tax? Now, I think that's quite a complex question, JP, but we'll appeal to your economist instincts, I think.
Right. So clearly there are taxes designed to modify behaviour, and we have tobacco excises and alcohol excises to discourage overuse of those products and recover costs associated with overuse of those products and some of the social externalities that are created from their consumption. Now, the issue with those taxes, I guess, is that the imposition of them, the costs paid by individuals might not be that closely associated with the costs they're imposed on society. Moderate levels of drinkers obviously don't fill hospitals, and they're paying the tax. Now, fees and levies, there should be a strong connection between the benefits to the payers and the costs being charged to them. But the way that costs are charged does have an incentive impact. For example, the classic would be audit fees. If you pay for the audit in a fixed fee, then it's independent of the hours spent. So the organisation being audited won't really mind if a lot of time's being spent on the audit. So it's really thorough because they're paying the same amount of money. If it's by the hour, then there might be incentives to try and have a hurry along and do a less than thorough job. So depending how charges are levied or fees are imposed, it can have an incentive impact. And so the classic example, and I think I talked about this before, is vaccines. The way that they're charged for is often less than their full cost because we want to encourage take up. And if they were charged for at their full cost, then you might not have the take up, which is useful for developing community herd immunity. So there are connections, obviously, between the way that charges are imposed and the incentive impacts that they have. So I hope I've drawn the distinctions there.
Actually, I could add a little bit to that. One of the things, the same choice happens when you're thinking about search charges for things like the company's register. You could impose, you could allocate costs to that, but that creates a disincentive to use to access something like the company's register. And so the choice is made to apply those costs at a different part of the system. And that is part of your cost allocation model, is to work out what the incentive effects of your charges might be and think about where the right place to charge is. The other thing I point out to people is that the charging point for a cost is different from it creates an incentive, but also provides for that charge to be passed on to other parts of the system. So it might be that this person is charged the levy, but in fact that's a proxy for charging their customers, and and levies and fees flow through the system like that.
Yeah, it's an interesting message, right? It says it's systemic, but also, and we do see this in some of the subcommittee conversations we're having, people not adequately, from a policy perspective, thinking through the incentive effects. And indeed, I think, Carl, you're pointing to unintended consequences as well. I guess I might just turn back to you, Carl, though, in terms of our next question as well, which in theory is about, in the current climate, there's quite a lot of fiscal pressure. The need to raise more revenue is pretty clear for the Crown. So the question then, though, is more a case of thinking about this from almost a legislative design perspective. How do you deal with that situation where there's that much pressure? The fees and levy setting powers not actually being used for the proper purpose. They're kind of almost dressed up in the way I think you were talking about earlier in our conversation. Do you want to talk a bit about that?
Well, I mean, I guess fundamentally it's about providing good advice and good advice about what the scope of what you can charge to third parties is, and also in identifying the risks of allocating costs where there's no legal basis for doing that. But also thinking about, if we do need to improve the cost allocation or the empowering provisions, giving the advice of this is the change to the empowering provisions that you would need in order to be able to fund this work from third parties.
Yeah, and it gives us pretty good controls too in terms of the legislation guidelines on one side, some of the engagement with the Treasury, and I suspect if all else in that sense was to fail, then there's quite a lot of commentary from the Office of the Auditor General and the Auditor General himself on that score. Might want to just turn to JP on the next question, which is related to cost recovery. Do you have any advice around practical first steps that should be taken when designing a cost recovery regime?
Well, we have a lot of guidance, obviously, which I'd recommend people to read through, and it goes through in some detail about the broad aspects of a regime that need to be considered. But like anything, we need sound analysis and supported by transparent information, which comes from a comprehensive understanding of the regime and the impacts it can have. In our guidance, we had some useful charts that can take you through thinking through cost recovery development stages at various points in times, from initial thinking right through to the detailed design, and there are templates to that end that will effectively help you at each stage in that process. Obviously, the guidance also has these principles, which I've talked about today. And, as I said, I think intuition is very useful there to work through what they mean and the practical consequences of them. You need to obviously have a legal perspective as well, and make sure that you have, the clear authorities to actually impose the regime that you would like. And you need to have the accounting methodologies to be able to recover those costs that you think are associated with those activities in a clear way with an audit trail, something that the OAG would be proud of. So you can show them how your regime works, why you're charging what you're charging, what the money's used for, that it's within appropriation authorities, and that you're not contravening any of the rules. We have to be accountable, obviously, for the design of our regimes, and so that needs to be thought through. You need to document each part of the process of what you've done and why, and what the consultation has come back with, how you responded to that and the feedback. So there's a lot in that I've just responded to, but I think the guidelines from the various agencies are a really good starting place. Thank you.
Yeah, and that includes some templates and some ways of doing this and so on, and particularly the Treasury guidance. The Treasury guidance on this stuff is actually very good, as is some of the material from the OAG, and the legislation guidelines actually help just buttress that in terms of then translating that into legislation. Hey, Carl, I want to go back to something you and I talked about earlier, just in terms of the approach to legislating for cost recovery and putting cost recovery principles. I think there's been a misinterpretation from one of our participants about the comment you made about primary legislation. Do you want to talk just a bit more about LDAC's focus in that context, the focus of the guidelines, but also then how that plays through into some of that secondary legislation as well?
Yeah, so just to be clear, I wouldn't be proposing to put cost recovery principles in primary legislation. The idea there is that good regimes understand what that regime's approach to cost recovery is. So you'll see a document actually I was involved in preparing that the Ministry of Transport has, which is their approach to cost recovery, or their approach to funding. So that's the kind of thing that I'm talking about when I talk about having a good approach or a well understood approach to cost recovery. If you put that in primary legislation, you risk inadvertently limiting the flexibility of what you're doing and preventing you from doing things that are actually consistent with the Treasury guidelines. So that's something to take care of.
But you still need an empowering provision in the primary legislation for a levy or a fee, though, right?
Yeah, that's right. So you need the empowering provisions to enable you to charge those things, but the principles for when you use different empowering provisions or different options is something that's set at the policy level rather than the legislation itself.
Yeah, that's helpful. Now there's a sort of slightly technical question, JP, but not quite what you think. There's someone in our audience who is relatively new to a bunch of this, and I'm sure there's quite a few of them. The question really is, how does someone in our audience or others who are kind of working their way through this levy and fee situation, how should they go about engaging with the vote analyst? And what's the role that the vote analyst would play in some of the stuff you've talked about this morning, JP?
Okay, so the vote analyst is most agencies' window into the Treasury. And as I said in my talk before, your finance team deals with the vote analysts a lot, and they should know who they are and their contacts. So they deal primarily with assessing whether a levy and fee regime is justified from a policy perspective, whether the various aspects of the Treasury guidelines have been followed, and that's to form an assessment whether it's a good idea and to start with, but also that it's being executed properly. Vote analysts often confer with other people within the Treasury around the tricky aspects of a regime. So, we always say vote analysts are kind of are like general practitioners. They field questions and they generally know the answers to most things, but there are some tricky things which require specialist advice from, and then they seek that in the Treasury. I mean, that could be tricky accounting issues, it could be tricky appropriation issues, it could be even some legal issues, and they will gather that information and they'll feed that back to the agency that they're dealing with. Sometimes agencies can directly deal with those specialised resources within the Treasury, but that's less common. Sometimes we have group meetings with the vote analyst, the agency, and some of those specialised experts. So the vote analyst is the window, just to repeat, into the Treasury, and it's the first port of call. And generally, they understand the processes and the issues, but also the fiscal context and the way that government is thinking about these issues in general. So they can help guide an agency about what to do and how to do it.
Yeah, no, that's really helpful, JP, and I do think that's a really good explanation about how to get into this world and get good advice. I'm sorry, we've got more questions than we've got time for. We're going to take one last one, which I'm going to direct to Carl from a couple of our participants on the same topic. A bit of a hat tip to one of them for identifying the fact that the Constitution Act talks about, is slightly confusing, about levying a tax, which I think just illustrates the point you made earlier. But more importantly, more seriously, you've talked about the PCO model provisions. When can our audience and other players expect those model provisions to see the light of day?
So we've consulted some agencies on those. We've had quite a bit of feedback, which is great. The way we operate model provisions tends to be something that is available to our drafters through our drafting manual. We haven't yet been publishing those model provisions publicly, but it is something that we're working on engaging with departments on so that they can see what those model provisions are. So it's an ongoing work program for us. And remember also the model provisions will apply for future empowering provisions rather than something that would apply to existing ones as well.
Yep. So then that's great. I mean, what that says is that if anybody working on this stuff, knowing participants today, particularly knowing there's those model provisions around, they can engage through their legal staff with PCO on that as well. That's helpful. So that's all we've got time for today. I'd like to thank all of our participants for being with us, and also to thank Jean-Pierre and Carl particularly for being such an amazing panel today. I think the discussions highlighted the key things to be aware of when developing and authorising the charging of fees and levies. There's a lot of wider reading and helpful resources available on this subject if you're interested. The Treasury and the Office of the Auditor General have helpful guidance documents. The legislation guidelines provide helpful design advice. And of course, LDAC is always here to discuss the design elements and provide advice. In that score, we encourage you to explore the LDAC Guidelines 2021 edition and specifically Chapter 17. We also value your feedback and always want to improve. It would help us if you could fill in the survey and provide feedback on the session today, please. And finally, look out for the next webinar. We'll let you know once we have set the date and a topic for that. We look forward to seeing you again next time. Ka kite anō.